What if you could just, cut through all the noise in those dense financial reports, get straight to what actually matters?
Well, that's exactly what we're setting out to do today. We are doing a deep dive into the latest results from EID Parry India Limited. This is for Q1 FY26, the quarter ending June 30, 2025. And look, this isn't just about numbers. It's really about understanding the big strategic shifts happening in a company with a long history operating in a really dynamic industry.
Absolutely. And we've got the key documents right here. The official financials, the press release, the investor presentation, all approved by their board on August 6, 2025. Our goal really is to pull out the most important bits, the surprising facts, so you can get up to speed quickly on what's happening with this, frankly, fascinating business.
Okay, so what can you expect from us today? We're going to unpack the overall performance first, then we'll dissect the key business segments, sugar, distillery, consumer products. How are they really doing? And then we'll zoom out a bit, look at the global and Indian market trends, see how they're shaping EID Parry's strategy. Where should we kick things off? Let's start right at the top, the big picture numbers, because they really do tell a tale of two performances, as it were. You look at the consolidated figures, and you see some pretty impressive growth, shows the strength of their overall group. But then you look at the standalone results, that's the core EID Parry operation, and, well, it's a slightly different picture. Still improving, mind you, but different. It's a really key distinction.
Right, and that consolidated leap is impressive. Revenue from operations jumped, 29%? Two R's, 8,724 crore, that's huge.
Well,
Over 87 billion rupees, up from about R's,
yeah.
6,747 crore same time last year.
Yeah.
And get this, the EBITDA, earnings before interest, tax, depreciation, and amortization, that shot up 70%, almost doubled, reaching R's 895 crore compared to R's 528 crore. Wow. And the profit after tax also way up. Ours from 246 crore compared to just Mars 91 crore last year. That's a strong overall story.
It is strong, but what's really interesting, maybe more indicative of the underlying shifts, is the standalone performance, that resilience you mentioned. Standalone revenue was, well, pretty flat. Ours 760 crore versus ours 751 crore last year. Not much movement there. But the standalone EBITDA actually swung into the positive Arshim 14 crore. That's a big turnaround from a loss of Rs 29 crore in Q1 last year. And even the standalone loss after tax, it narrowed significantly down to Rs 28 crore, which is 280 million rupees. That's much better than the Rs 79 crore loss the year before. So even without huge top-line growth in the core business, they're improving profitability.
Okay, so that divergence is pretty stark. Consolidated flying high, standalone, improving, but flatter on revenue. What's the key context we need here? Is there something we're missing in just comparing these quarter numbers?
Yeah, that's crucial. You have to remember the seasonality of this business, especially sugar. So comparing Q1 this year directly to Q1 last year isn't always, apples to apples. The cycles matter a lot. So instead of getting bogged down in exact quarter-on-quarter changes, we should focus on why things are changing, the underlying drivers, the strategic moves they're making, seeing the bigger picture, the direction.
Right, that makes sense. And that difference between consolidated and standalone really points us towards the individual segments, doesn't it, where the action is. And maybe surprisingly, their original core business, the sugar division, still seems to be facing some challenges. Needs a bit of sweetening itself.
You could say that. Yeah, look, despite being one of India's biggest sugar players, their consolidated sugar operations, and that includes the refinery, still posted a loss before interest and tax. It was Rs 30 crore this quarter. Now, that is better than the Rc 55 crore loss they had in the same quarter last year, so improvement. But standalone sugar revenue, that was Rs 347 crore, which is actually down 14% from Rs 404 crore. And that's mostly because of lower government release quotas for domestic sales. Policy impact right there.
Okay, so lower revenue, but a smaller loss. That suggests they're managing costs or getting better prices, maybe. What does that tell us about their long-term play for sugar? Are they trying to shrink it or just run it more efficiently while they grow elsewhere?
I think it's more about efficiency and value extraction right now. The standalone loss improved from Rs 59 crore down to Rs 49 crore, and that improvement came even with lower revenue. How? Well, higher cane volume crushed 2.11 lakh metric tons versus 1.93 LMT last year. Also, better realization, the price they got per kilo improved by about 8% overall, and like you said, cost optimization. Now, this was partly offset by lower sugar recovery from the cane and higher cane costs, but still, even though their institutional sales volume dropped 21% and retail dropped 33% again, because of that lower quota, they managed to get more value per unit sold, making the best of it.
Okay, making the best of a tough segment. Now let's flip to a segment that seems to be firing on all cylinders. The distillery. This looks like a real growth engine.
Oh, absolutely. And what's fascinating here is how it connects directly to government policy driving growth. It's a standout. Revenue up 12%, reaching Rs 296 crore from Rs 263 crore. Profits also climbed nicely to Rs 20 crore from Rs 13 crore. And a big reason for this is better capacity utilization. They finished some expansion projects, and now they're running those distilleries harder. And if you connect the dots, this is super relevant because of India's ethanol blending program, the EBP. By June 2025, the ethanol blend in petrol hit almost 19%. The target is 20% for the 25-26 supply year. And get this, 34 lakh metric tons of sugar were diverted just for ethanol in the last supply year. So EID Parry's distillery expansion is perfectly timed to capture that demand. It's definitely a strategic growth area.
Yeah, those distillery numbers are strong, and the EBP link is clear. But does relying so heavily on a government program introduce its own risks? Or is this seen as a sustainable, diversified play for them long term?
That's a really good question. There's always some policy risk, right? But EID Parry seems to be mitigating that somewhat by focusing on multi-feed distilleries. That means they can use other things besides just sugarcane juice or molasses, maybe grains, other biomass. That makes them more flexible, less dependent on just one input or one policy nuance. So yeah, while EBP is the big driver now, the strategy looks towards a more, let's say, resilient bioenergy position.
Okay, interesting. So beyond sugar and ethanol, they're making other moves too. Let's look at the consumer products group, CPG. It's a bit of a mixed bag, isn't it? Overall turnover down, but some pockets of strong growth. What's happening there?
That's exactly right. A bit of a paradox. Overall, CPG turnover fell 11% to Rs 192 crore from Rs 216 crore. And the main reason, again, that lower sweetener release quota hitting their sugar-based products in that category. However, within CPG, the staple segment, think non-sugar food items, grew a very healthy 33% compared to last year. So you see a clear strategic shift. They're focusing on sales channels with better margins and pushing towards value-added products. For instance, their brown volumes, premium sugars like Demerara sales went up quite a bit, from about 1,678 tons to over 2,200 tons. That's now 12% of their consumer pack volume, up from 8% last year. Deliberate move towards premiumization.
And it's in CPG where we see that really bold move into FMCG, fast-moving consumer goods, right? With the super grains range.
Yeah.
That feels like a major strategic pivot moving well beyond sugar. How are those new non-sweetener products doing? What were the Q1 sales like?
It absolutely is a major pivot. It signals their ambition to be a much broader food and nutrition company. The Q1 numbers for these new lines are, well, they're starting out. Rice brought in Rs 25 crore in sales value, pulses Rs 23 crore, and millets Rs 27 crore. So, these aren't huge numbers yet compared to the whole group, but they clearly show the direction. They're building a foundation in these new categories. It's about transformation.
Okay, but not every segment is on an upswing. The nutraceuticals division seems to be struggling a bit, and you mentioned there was a significant financial detail sort of hidden in there.
Yeah, nutraceuticals faced some headwinds this quarter. Standalone revenue dropped 29%, down to just under a 6 crore, so quite small. The consolidated nutraceuticals division actually reported a loss before interest and tax of Rs 10 crore. That's a swing from a Rs 1 crore profit in the same quarter last year. And the key detail, the significant item, is an impairment charge. It was INR 36 crore, related to the discontinuance of something called Alimtech operations. So for listeners, an impairment basically means the company's formally recognizing that an asset, in this case Alimtech, isn't worth what it was listed for on the books. Often signals they're shutting it down or writing down its value significantly. That hit the bottom line for nutraceuticals this quarter.
Got it, an impairment charge. Okay. And finally, wrapping up the segments, there's the Farm Inputs division. This comes through their subsidiary, Coromandel International, and it sounds like a real powerhouse contributing to that strong consolidated picture.
Oh, absolutely. Coromandel International Limited, or CIL, is a major player in farm inputs, fertilizers, crop protection, and its contribution is huge. The consolidated farm inputs operations reported a profit before interest and tax of Rs 741 crore. That's up substantially from Rs 494 crore last year. So yeah, CIL is a consistent, strong performer for the EID Parry group, and a key reason those consolidated numbers look so good at the start.
Okay, great breakdown of the segments. So now let's try and connect these pieces to the bigger picture, the broader industry, the strategic context, these external forces shaping EID Parry. What's the global sugar situation look like right now, and how does India fit in?
Well, globally, the outlook for the 2025-26 sugar year is for a slight surplus, mostly because production is expected to be up in places like Brazil, India, and Thailand. But there are always risks. Lower cane yields, maybe falling sugar prices could hit Brazil's output, for example. So it's not set in stone. Volatility is common. For India specifically, the government allowed 1 million metric tons of exports for the season that just finished, 24-25. But Indian mills only actually contracted about 6 lakh metric tons, 600,000 tons. Why? Mostly because domestic prices were higher, more attractive than exporting. It shows that interplay between local conditions and global markets.
Right. And beyond sugar, what about other crops? You mentioned they're moving into grains and pulses. How are those broader agricultural trends looking?
Yeah, that diversification makes them more exposed to, well, the whole agricultural cycle,
Mm,
which is very monsoon dependent, of course. This year, for example, the All India Kharif sowing, that's the monsoon season planting, is actually down about 4% compared to last year, as of the latest reports. Now, within that, the area planted with pulses is up slightly, about 2%. But specific crops they're interested in, tur or pigeon pea area is down maybe 5-7%. Urad dal, black gram, down about 12.5%. These things directly impact market prices, obviously, affects their raw material costs if they're buying, and the potential selling price for their new FMCG products. It's a complex picture.
very complex. Okay, and speaking of inputs and processing, let's circle back to the refinery business. We touched on it with sugar, but it sounds like there's a turnaround story there too, maybe, and they're investing in it.
That's right. The refinery business, it has a capacity of 9 lakh metric tons per year. In Q1, it sold about 2 LMT, generating revenue of around INR 908 crore. Now, the key thing is the refinery spread. That's basically the profit margin between buying raw sugar and selling refined sugar. Those spreads had fallen to really low levels in the second half of last financial year, but they've recovered now in Q1. And the company's really focused on making this refinery segment, quote, profitable and sustainable. They're doing that by controlling costs, improving efficiency like melting rates, using biomass for energy, optimizing processes. And yes, underlining this commitment, the parent company, EID Parry, actually infused INR 350 crore into the refinery subsidiary this quarter. Part of it was converting existing loans to equity, part was fresh cash. It definitely signals they want this part of the business to be stronger, more reliable.
Okay, so cost control, efficiency, fresh investment in the refinery. It all points towards, well, quite a strategic evolution, doesn't it? This isn't just minor tweaking.
No, not at all. It's fundamental. You have a company with this incredibly long history over 235 years, primarily known as a sugar company. And it's actively transforming itself into something much broader, a food, nutrition, and bioenergy company. That's a massive shift. It requires new skills, new market approaches, probably even a cultural change internally. And it's underpinned by all those strategies we've talked about, focusing on cane volume for efficiency and sugar, expanding those multi-feed distilleries for bioenergy, growing institutional sales, and really pushing hard into the consumer market with the CPG, especially the new FMCG lines.
And are there signs this transformation is still gathering pace? Any hints of future growth initiatives, maybe bigger moves on the horizon?
Yes, definitely. The commentary suggests they're actively looking at things like potential mergers, acquisitions, partnerships, inorganic growth. A concrete example is their subsidiary, Coromandel International, making a move to acquire a controlling stake up to 53.13% in another company called NACL Industries. Now, that's subject to regulatory approvals, of course, but it shows that kind of ambition to expand their footprint, potentially through acquisition. They also make a point of highlighting various awards they've won, particularly around environment, health and safety, EHS, and water conservation, which suggests, alongside the growth push, there's a focus on sustainability and operational excellence, too.
Okay, so we've covered a lot of ground here. Let's try and distill it. What does this deep dive into EID Parry's Q1 FY26 results really reveal for you, our listener?
Well, I think the main takeaway is that this company, despite its deep, deep roots in sugar, is genuinely on an ambitious path. They're diversifying, transforming into this broader food, nutrition, and bioenergy player. These Q1 results, yeah, they're mixed across the different segments, but you clearly see the strategic pivots, the big investments they're making in new growth areas like bioenergy and FMCG, and they're doing this even while navigating the usual seasonal challenges of their traditional sugar business. It's a real balancing act right now.
It certainly sounds like it. And given that long legacy in sugar, and now this really aggressive expansion into FMCG and bioenergy, it does leave you with a big question, doesn't it? How exactly will EID Parry manage to balance the demands, the seasonality, frankly, the volatility of its core sugar business with seizing these new growth opportunities in very different, very competitive markets like FMCG? And what kind of long-term impact will this fundamental shift have on the company's financial resilience and maybe more importantly, your understanding of what EID Parry will be in the future? Something to think about.